Okay, well, I think we can start. A lot of people joined already, and probably some more people will join a little bit later. But welcome to today's Global Dairy Farmers, in short GDF's webinar, Short and Medium Term Dairy Market Outlook. My name is Yvonne Osservoort. Today I will be your webinar host. And next to that, it is my goal to connect our GDF farmers, our members, with each other, and as well to our business partners. Well, I already saw a lot of you joined today. I saw Marcel from Lely. I saw a couple of people from Merck, MSD Animal Health also joining. And of course, our dairy farmers. I saw Richard from the UK and Willie from New Zealand. And a lot of countries are represented. That's fantastic. So Uruguay, great. And a couple of new people, fantastic. So I'm Global Dairy Farmers Operational Manager and your host of today. This webinar will last approximately 1 hour, depending on the number of questions asked and the type of questions. So before we officially start this webinar, let me show you a little bit how the webinar functionalities work in case you don't know yet. And also I will tell you about the outline of today's webinar. So a little bit of housekeeping. Oh, yeah, here we go. So first of all, this webinar is recorded. That means that within 24 hours after it is finished, you will receive a link so that you can watch this webinar again. And second, so here you go. At the bottom, you see 3 functionalities, 3 items: chat, raise hand, and Q&A. So for this webinar, only raise hand and Q&A is enabled. So we might ask you a question and we ask you to raise your hand. For instance, we can practice it right now. My question to you is, who thinks dairy belongs in a healthy and nutritious diet? How to do that? Oh, I see already a lot of people raising their hands. You click here. It's rising, 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 rising. That's wonderful. I wanted to say, oh, only one, but no, there's proof. I think everyone. Okay, so I believe many of you know, get the lower hand. Then the Q&A. Here it is, Q&A. So probably this is the most important functionality. You can put your question here. You have for Mels, our president, Ad van Velde, or myself. You can post your questions all the time during the webinar. How this webinar is structured, Mels has divided his presentations in a couple of parts, a couple of blocks, and after each block he will try to answer as many questions that are asked. In case it happens that some relevant questions remain unanswered, within a week after this webinar, you will receive answers to those questions through the email. So this is how it goes. So today's webinar outline, the official welcome is done by our president, Global Dairy Farmers President, Mr. Ad van Velde. He's a very passionate dairy farmer from the Netherlands, very successful as well. He will introduce you to GDF and also to our speaker of today, Mr. Mels Boer. Then Mels Boer will take over, and as I said, his presentation is divided in a couple of blocks, and after each block he will try to answer as many of your questions. When this presentation is finished, there will be a panel discussion where we invite 3 people of the audience to basically turn on their camera and their sound and to discuss with Mels more into depth what well, on today's topic. So the short and medium term dairy market outlook. And finally, some closing words by our president, as well as the announcement of our next webinar. So for now, sit back, listen, have a nice cup of tea, coffee, maybe even a beer for some, and fire away with your questions. So I give the word now to our president, Mr. Ad van Velde. Let me see. Here you go. And give it away, Mr. President.
From my side too, welcome to every participant to this Global Dairy Farmers webinar about the international dairy market. My name is Ad van Velde, dairy farmer in the Netherlands and president of GDF. Global Dairy Farmers is the only unique network in the world of real practicing dairy farmers. GDF farmers are very progressive, very successful with a strong focus on what's happening in the world. We inspire each other enormously and are very positive and passionate about the dairy industry. Besides the farmers, we have a great team of business partners around GDF, all leading in their branch and very international orientated. It's fantastic to further develop GDF with these inspiring dairy farmers and our business partners. Every year, GDF organizes its annual congress somewhere in the world. Besides our main congress, we organize or join several smaller events. Our next main congress will take place in Brazil and Argentina, hopefully in March 21. On this congress, we will discuss what's happening in dairy around the world via top keynote speakers, via workshops, solution centers, farm visits, and so on. And we are always looking outside the sector during our congresses. With the coming video, you get an impression how a GDF Congress looks like. This video was a short impression of our Congress in Europe in 2018. And Yvonne will start it. Members. a short impression of our European Congress. Our speaker, Global Dairy Farmers, is very proud to introduce Mels Boer to you. Mels is Global Dairy Analyst at the Hoogwegt Group. Hoogwegt is world's largest privately owned dairy trader in the world, with offices around the globe and sales in more than 130 countries. Besides trading as the main business, Hoogwegt also owns and rents dairy factories around the world. And Hoogwegt is business partners of Global Dairy Farmers. I'd like to give the word to Mels, and he will give his opinion about a somewhat uncertain, challenging dairy market right now. Mels.
Okay, good afternoon. As introduced, I'm Mels Boer. I work for Hoogwegt. My role within the company is I am the global dairy analyst and try to gather all the data from around the world and process that into a strategic outlook and trading possibilities for our organization. Well, Global Dairy Farmers asked me to make a presentation on what we are seeing happening in today's world and how that's going to impact the farming, the dairy farming around the world. So let me give it a try and start sharing my screen. Can you guys all see the screen? Okay. Well, to start with, what I would like to do is divide my presentation in three subjects. First, a little bit about the virus circling around the world and what the impact is on the wider economy. Then I would like to have a look at the global production outlook. And I hope with all the dairy farmers around the world that you guys can also give me some feedback if I make any mistakes in my forecast. Next to discuss is the global demand. And then it's a matter of combining supply and demand with government interventions and drawing a conclusion. Well, what do we know so far about the COVID-19 virus? Everybody knows it started in Wuhan, China, but so far I think the best statistics around the world is from Belgium, where 1.5% of the people infected have died from this virus. Well, if we now look at the rest of the world, then we see around the world only 283,000 people died from coronavirus, and that is roughly 1 in 10,000 people around the world. However, the problem is this virus is quite contagious. There is no medicine, there's no vaccine, and well, it's unlikely to see 100% of the world's population getting infected. But if we would multiply the world population by 1.5%, which is the amount of people that died in Belgium, then potentially 234 million people could die. Far more of a problem is, even if we find a vaccine, and like we know from HIV or the dengue virus, you cannot always find a vaccine, then it will take at least 24 months before the world is vaccinated and this vaccine or medicine is properly distributed. On the positive, this worst case scenario of 1.5% of the world population dying is roughly equivalent of 16 months of global population growth, given the fact that for the last 10 years, the global population grew with 1.1% per year. But what we do know is that this virus has got a huge impact on the dairy prices. They have fallen in the US by approximately 45%. And a big global financial crisis is developing.
Mels?
Yeah?
Sorry to interrupt. Maybe you can enlarge your screen? Like on the...
Yeah, let me see. Is this better?
Yes, that's better. Perfect. Okay.
Okay. Well, what we have seen in the past, and I looked at Wikipedia, a lot of financial crises. The main ones as listed on Wikipedia were listed in this row. But what we can see in orange, there was an implosion of a financial bubble. Countries were overly in debt. Or in red, there was an outbreak of a plague or a pandemic. In blue, a drastic oversupply in commodity. Or in green, currencies losing value and causing a financial crisis. The problem what we have is that we have all four of them at the same time. So from that point of view, we can say this is not a normal crisis, but it's potentially a quadruple crisis. And on top of it, the world population could shrink by 1.5%. So that's not a very rosy picture. But we already see quite some developments in the world. On the left-hand side, we see the global monetary policy, so effectively the interest rates diving below zero. We have seen the fiscal deficit being for the G4 and China combined at -10%, which is almost double the amount as the government deficit in 2009. And if we look at the US, we see the weekly jobless claims skyrocketing. At the moment, in the last 2 months, more than 30 million people became jobless in the US. And if you divide that by the population, then effectively the unemployment is already worse than the situation during the Great Depression of the 1920s. So we have a serious problem happening in the world. Well, as always, how do we try to get out of a crisis like this? Well, that is government spending and increasing the government debt. Well, the big question is, will the declining world population be able to pay all the outstanding debts? Well, if we look at the right-hand chart, zooming into only the US, well, then we can see that the US economy-wide debt is already at approximately 250% of GDP. And the outlook is that it will rise to 300% of the GDP. And what we effectively are doing at the moment is currently we are rolling over debt with cheaper, lower interest rates debt. We are doing quantitative easing, and in some countries like the UK, the central bank has started with monetary financing, so effectively printing money, which enables the government to spend. And people might remember what happened in Germany and other countries when you start printing money to let the government spend. But what the government is doing so far is they're giving income support and they're intervening in the economy. But if governments and central banks are procuring government bonds like they are doing today, and we can see in the right-hand top charts, we see the government bond index from 2005 to 2020. Well, central banks are buying so many government bonds that the price of government bonds has skyrocketed. But what do other investors, effectively other investors are buying assets the central banks cannot print. We see that the price of the Nasdaq share index has gone up over the last 15 years. But also lately, people are buying again gold, bitcoins, and other products central banks cannot print. But interestingly enough, governments can also not print farmlands. And over the last 15 years, I published on the right hand a chart of the USDA with the farmland price in the US in dollars per acre going up from $1,600 per acre in 2005 till about $3,200 per acre in 2020. Well, that's partly due to the global population increasing, also due to the industrialization. Mothers that work in a factory can't breastfeed their children, and therefore we see that a new generation is growing up consuming much more animal protein than before, but also part of the reason for farm values to go up is the falling interest rates. But that's going to have its impact on the price of farmlands. And if we look at the right-hand side, we can see the charts where the price of the farm sector assets is published. It's inflation adjusted, but as we can see, the price of farms is roughly at the same levels as we saw in the 1980s, whereas the interest rate in the 1980s was close to 15%. At the same time, we see that currently the overall debt of the farm sector is less than we saw in the 1980s. But if we combine that and a combination of unlimited money getting printed, so therefore inflation of asset values, commercial banks that are flooded with money, they won't let their customers default. No, they rather roll over their debts into more debts and inflate asset prices. At the same time, with the global rise of the population around the world and people eating more animal proteins, I think that the value of farmlands will become a scarce resource. And given the very low interest rates, I can foresee that the price of farmlands and also farm debt will go up. But before going into the global production outlook, are there people who disagree and think that the farmland price go down? And I must say, Yvonne, I can't read the questions. So are there any questions?
Until now, there's one question.
One question of Alphonse, will the price of farmland increase everywhere? Well, everywhere is a very big question. Of course, I don't know what's going to happen in, let's say, the Ukraine or other places, but I think the overall tendency of banks is to say, we need to divide between small farms and big farms. Big farms pretty soon become too big to go bust. And I think just like big airlines, big farms will have their debt rolled over for lower interest rates. And what we will see is if a small family farm with 100 cows is going to default on their debt, then most likely the banks will say, hey, there is another farm in the neighborhoods having 1,000 cows. You know what? We will move, we will make the farm with 1,000 cows, 1,100 cows, and yeah, we will see a consolidation of the dairy farm sector, is my opinion, and that will be financed by debt. And I think for the banks, given the fact that the interest rates are so low, they rather have customers increasing their leverage and increasing their debt levels than having customers default. Well, question, when will the rent, the interest go up? To be honest, I don't know, but I think it's going to be very difficult to have the interest going up, simply for the reason that there is too much debt in the world. And I think, yeah, what you normally see if there's too much debt in the world is that at a certain moment, central banks will implement new currencies or withdraw one of the zeros in the yeah, value of the currencies. Then let me answer one more question before going to the next subject. Well, what caused the peak in the 1980s? To be honest, I don't know. In the 1980s, I was at primary school and I cannot really remember. But Alphonse is asking, so too big to fail also goes for dairy farms and not just for banks? Well, I think that is the case. My view is big farms will stay afloat. For banks, it's way easier to refinance them than to make them default on their loans. Well, I see several more questions. I must say, the one of Murray, while your thinking may be logical, it requires confidence for this to happen. Currently, uncertainty is significantly lowering confidence internationally. Well, that's true. In any crisis, confidence is going up. People and financial markets are always either manic or depressed. I think currently we are depressed and mood is swinging around. Let me simply go to the next part of my presentation. Otherwise we will end up discussing things too long. Now, next subject is my global production outlook. Well, what I put in the left-hand side is the global production loss reported for various countries around the world. And as we can see, the big continents, EU loss published up 3.5%, US up 2.4%, New Zealand down 2%, but it's the end of the season. Argentina up 6.5%, Australia up 7%, but also China, being the biggest dairy importer, their production was up 4.3%. My take is, in the Northern Hemisphere, the cows are in top form. And at the same time, due to the COVID-19, there is too little slaughterhouse capacity. And if you have a cow producing 15 liters of milk and you can't get her pregnant and you can't get her to the butcher, well, what will you do? You will continue milking that cow because it is springtime, grass is for free, but it also implies that economically less viable cows keep on producing till September. On the negative, there is talks of a potential drought in the EU. I don't buy that that much, simply because in 2018 and 2019 it was also very dry. So we're effectively comparing a dry year with another dry year. What I hear speaking to farmers is at the moment farmers are on average quite content with their milk price. And farmers, if the prices are good, they will produce whatever they can. And if the prices go down, they will try to produce even more to keep their income going up. Also, at the moment, what I hear from farmers early of the part of the flush, people say, I rather milk and feed as much as possible because I rather have money on the bank than a huge pile of silage for next winter. Hopefully rain will come later in May or June, and then we will make our silage for next winter. So altogether, for the whole world, I am forecasting to see a supply growth of 1.1% in the coming 6 months. What I also, just to demonstrate how I approach markets, is I made a model of the milk production, and in this case, the right-hand side, it is the milk production in the US. And what I said is, well, if we know the cost of interest, the cost of gas oil, the cost of feeds in the form of the corn price, and the price of milk, then we can model the output. Well, given that model, we are at the moment forecasting a 1.4% year-on-year increase in US milk production. Also interesting to see, if you look at 2009, the previous global financial crisis, is that the production cuts only took place in October. So I think it confirms when grass and feed is almost for free, people will simply keep production up, and the decline in production will take some months until the cost of feeding the cows will go up. On top of it, slaughterhouse capacity will make it difficult to reduce your production at this moment of time. Are there any questions on the production outlook? 1.1% up for the next 6 months. Well, then I hope this is clear. So let's have a look at the demands. Well, as we all know, China is the biggest importer of dairy products in the world. And China is a very positive country. It hasn't seen a negative GDP growth since the 1970s. And already we are seeing positive vibes in the Chinese economy. China has also seen a very healthy demand growth in the last 10 years. On the raw milk powder, for example, 12% up year on year. S&P skimmed milk powder 18% up year on year. Butter and AMF imports on average 16% up year on year. And cheese imports up 16% as well. Meanwhile, the Communist Party sets itself a target to be 70% self-sufficient in dairy. However, for the first time since the 1970s, the Chinese GDP has shrunk by almost 7% in Q1 2020. And the World Bank sees Chinese growth declining from 6% last year to only 2% this year. Chinese domestic milk production was reported at plus 8.3% by the Ministry of Agriculture and plus 4.3% by the National Bureau of Statistics. So effectively a positive domestic milk production growth. And what we are seeing is on the consumption side, Yum Foods, the owner of Pizza Hut, saw their sales decline by 15% in the first quarter. And in in April, they were 10% down. Starbucks China, which effectively is selling more dairy in the form of cappuccinos and butter croissants than coffee, saw their sales decline by 50% in Q1, and they expect to see a decline of 15 to 20% in the full year of 2020. So the demand is not there in China. At the same time, we see increased drying of raw milk powder in China. During normally around end April, the Chinese start to dry raw milk powder. This year, the Chinese already started drying raw milk powder in February. As such, it's surprising to see that there is only a 3% decline in the raw milk powder imports in Q1, while we saw a 70% import growth of butter and AMF in Q1 and a 26% cheese import growth in Q1. Well, let's do some calculations. If China is 70% self-sufficient, we have seen high imports figures for butter and cheese and high domestic production of milk and milk powders in Q1. This should have its impact on the imports in Q2, 3 and 4. The Chinese don't have a culture of eating cheese, butter, milkshakes, cappuccinos and ice cream at home. And restaurant sales are down by at least 10%, and they are likely to go back to normal by the end of the year. Well, if we say the domestic demand is flat and the food service demand will be on average down by 5% in Q2, 3 and 4, then we can forecast approximately a demand decline of 2.5%. If at the same time we say the domestic milk production will increase by 4% year on year in Q2, 3 and 4, and I think that is likely to happen given the high rates of heifer imports and the new farms that are started by, for example, Yili, having a 100,000 cow farm coming into production in Q2, then my calculations would imply imports have to decline by almost 18% to keep the Chinese stocks at the same level. If imports will be higher than minus 18%, the stocks will go up in China. And I think it's good to explain a little bit why these stocks are so important. Well, demand is not the same as consumption. Humans are just like cows, herd animals. And let's give an example of when the coronavirus broke out, everybody was buying toilet paper. This increased the demand for toilet paper, but people don't go more often to the toilets, so consumption was flat. Now everybody is well stocked on toilet paper, and there is no demand for toilet paper because people are destocking their toilet paper. There's still the same amount of consumption. In commodity markets, we see something similar. When prices come off, Western traders and purchasers working for Danone will lower their inventory. They work with a first in, first out accounting system, or mark to market. And that forces players to reduce their exposure, so reduce their stocks. Interestingly enough, in China, we see the opposite in commodities. Custom statistics for March highlights that crude oil imports were up by 4.5%. Butter imports in March were up by 99% year on year. Cheese imports were up by 24%. And copper imports were up by 13%. Well, don't be fooled by these strong import figures. It looks like Chinese companies are using a last in, first out accounting system that enables them to buy cheap and use cheap imports and roll forward the expensive inventories. However, just like your toilet paper, one day these expensive inventories need to be consumed. And unfortunately, domestic demand is not supporting the consumption of these expensive stocks. Looking at the car sales, March car sales in China was down 41%. Smartphone sales down 22%. Starbucks is expecting a decline of their sales of 15 to 20% in 2020 in China. So domestic demand is not consuming all these stocks, and nor do the exports, because exports are falling. March exports were down 6.6% year on year, and Jan and Feb exports were down 17% year on year. So my conclusion towards the Chinese imports is, don't be fooled by the strong import figures, given the above decline in sales and exports. I fear that the Chinese commodity consumption is way lower than the import figures suggest, and on the back of it, their imports later on this year will decline. On the other hand, we have the US. And the USA, we see a real change of eating habits. Well, what we see so far in the US is that the US restaurant sales are down by 65%. And the dairy demands from food services normally is 30%. Well, if we multiply 30% by 65%, then we should see a reduction of dairy consumption of 19.5% of the total dairy demand by the food service sector. Well, a 19.5% decline in dairy demand is quite significant. Fortunately, the American people do like to go to the supermarkets, and the supermarket sales are actually very, very healthy. Looking at the overall dairy year-on-year consumption, we see it going up from 1.5% by the start of the year to 16% in the last published figure of the 19th of April during the Corona crisis. So that is a very high import growth. We also see a 22% increase in natural cheese. We see butter sales going up by 15%, processed cheese going up by 22%. And these are very strong figures which are published, especially as the week of the 19th of April was the week after Easter. And what we can see in the table is that the American citizens bought even more dairy products in the week before Easter. But after Easter, still demand was up by 16.4%. Effectively, that means that the domestic consumption in China, in the USA is maybe down a little bit, but potentially even flat. People simply like to eat fatty foods when they are in a stressed situation. People have the time to have a proper breakfast with their children because they don't have to rush to go to the office. People have to entertain kids at home. They start baking, use butter, milk and other products to make cookies or pies. And overall, the domestic consumption in the Western world is actually very healthy and very good. Then let's have a look at the oil exporting nations. Well, many of the oil exporting nations are also dairy importers. For example, the Middle East and North Africa, Mexico, North America importing quite a bit of cheese and butter, Russia and Central America. These regions together import 29% of the whole milk powder exports, 41% of the S&P exports, 51% of the AMF and butter exports, and 48% of all cheese getting exported. However, the current Brent crude price is around $22 in the month of May so far. Well, in the right-hand side, I plotted an XY scatter where on the horizontal X is the price of the Brent crude, and on the vertical X is the growth of imports in the 12 following months. So Totally on the right-hand side, you can see when the crude oil prices were around $130 a barrel, we either saw a flat growth or a 15% increase in imports of dairy products. Likewise, when the market price of Brent crude will go down, the amount of dairy products imported will also go down. And my regression formula forecasts that we will see a 1.8% reduction in imports by the oil exporting regions. Well, now we go. We see we have more production, less demands. Luckily, we also have governments intervening with direct income support or private storage help. Well, the EU is mainly helping with private storage aids or intervention, so effectively buying the oversupply that exists today and hoping to sell it in the future. So effectively, they're rolling over the current oversupply into the future. And in the US, we see that the governments are giving the dairy farmers income support of almost $3 billion US. Well, if you subsidize farmers to produce, then you will end up with more production. At the same time, we see that the US government is also giving some aids for the needed, and they're intervening at the moment, buying $317 million US of dairy goods for food support, which is approximately the equivalent of 6.1% of the fluid milk production, 4% of the cheese production, 5% of the butter production, and 1% of the yogurt production. Well, my take for the moment is the above measures will not resolve the current oversupply. They are going to delay the moment that the dairy is no longer oversupplied, because by giving farmers income supports, they will stay alive and keep on producing. And by buying a lot of intervention or subsidizing storage, you only move the current oversupply into the future. However, what we see so far, and today the first news was published about the private storage aid, and the first round of private storage aid in the EU saw that 15,000 tons of butter went into the PSA. That is 7% of the May production and 10.7% of the total volume available for the PSA. For the cheese, we saw that 2.7% of the May production went into the private storage aid. And interestingly enough, in the middle chart, you see that most of it went to Italy. I reckon that that is Parmesan cheese that is getting subsidized to be stored. So effectively, the EU is giving income support to manufacturers of Parmesan cheese to do the normal thing they always do, produce Parmesan and store it for about 24 months before selling it. So that won't have much impact in the overall oversupply of cheese. On the skimmed milk powder, we only saw 1,200 tons going into PSA. That is 0.7% of the May production. And that, I think, is very positive to see. From the looks of it, it feels that only very limited amount of milk powders went into storage. And that could indicate that the oversupply of milk proteins or skimmed milk powder is far lower than the prices are indicating. Well, as such, the US is buying at the moment dairy to help the needed. And as we can see from the charts, there are a lot of people in need. At the moment, about 17% of the mothers with children under 12 are not having enough money to afford enough food. And with children above 12, it's almost 41% of the mothers with children above, sorry, the purple says mothers with children 12 and under, 41% has got food insecurity. I reckon that the problems with the huge loss of employment in the US is creating far bigger problems than the current food subsidies will cover. And if I look at the ratio, I think the US government support helps, but it's not enough. Well, if we have to summarize everything, I think it's good to ask ourselves, who will be the winner? Well, what we know so far is the world economy is declining due to COVID-19. On the supply side, we see the dairy production rising. And on the demand, we see the dairy demand falling. Government intervention at the moment is either too little, or it's a matter of rolling oversupply the stocks into the future, prolonging the oversupply. And I think we have to question ourselves, maybe there are no winners. And for you as farmers, it's going to be a matter of how to avoid becoming a loser. Well, looking at the current charts of the class 3 spot milk price in the US, we see that the market is at the moment very low, but certainly not at the lows as seen in 2009. Whereas the futures curve, which is the red line, is trading on average at a substantial premium to today's spot. If we now place the current futures curve over the actual performance during 2009 and 2010, then we can see that given the fact that this crisis could potentially become way bigger than the crisis seen in 2009, the current milk prices are way higher than the actual realized prices as we have seen in 2009 and 2010. And I think for the farmers that survived 2009 and 2010, I think all of them would have loved to have hedged their outputs in 2009 and 10 at today's futures curve levels. Especially if you combine selling your future output of milk with buying your future input costs as well. As we see at the moment, the Chicago Board of Trade's corn futures are trading way lower than the prices we saw in 2008 and 8, 9 and 10. The current cost of gas oil or diesel is at the moment way lower than the prices we have seen in 2009, 10 and 11. And I think, coming to a conclusion, we are heading into difficult times. And as the English expression goes, when the going gets tough, the tough get going. But I think, given today's milk prices and input costs, it's probably a good moment to reduce your risk and sell forward your milk output and buy forward your feed and fuel. Well, let's see if there are some more questions I can answer. Quantities of milk lost in the US, it's something I need to foresee. I don't have in the back of my mind. Where is the butter going to China? I think it's heading into products like croissants, cakes, probably that sort of things. Andrew Brewer asks, please can you share demand figures for milk and plant products? Well, I can, and I will go back. Well, I do have the statistics, but unfortunately not in this presentation. What we effectively saw is that in the US, the demand of raw milk, liquid milk, grew faster than all the plant-based alternatives like soy milk and almond milk. And I think everybody knows that milk is very healthy, but we also see currently publications that eating real dairy products and especially yogurts could help your immune system, and for that reason have a positive impact on your immune system during the COVID-19. I've seen that in UK newspapers, but also in newspapers like the Jakarta Post. Really, Lentering, there is still the same amount of money in the world. No government took money out of the market. They even printed more. Where is all this money going? Personal savings accounts, medical sector. Well, what we see at the moment is, effectively monetary financing. Central banks are printing money that is spent by the government. The governments are helping the unemployed. Governments are at the moment subsidizing a lot of people running businesses, airlines, small businesses like hairdressers are getting subsidies. Effectively, what governments are doing is they are happily spending as much as they can. Some governments, for example, the US, they're heading into an election. Typically, the environments that governments love to spend to become popular. And at the same time, I think that is also the reason that the stock markets are performing so well given the significant GDP decline that we are seeing. That money partly ends up in products central banks cannot print, and that is things like property, gold, bitcoins, equity. Jan writes, China has good whey imports these days. What do you expect on the whey in the coming months? Well, my outlook for the whey is actually quite positive. What we see in Europe and also in the US is that drying towers rather dry products for 1,900 euros a ton like S&P, then drying whey for 700-800 euros a ton. As such, a lot of whey is currently going as liquid whey to the porks and the calves, and not even getting dried. And total whey production is disappointing. At the same time, we see a huge effort in China to increase their pork production. They have the African swine flu in China, but at the moment the Chinese are importing a lot of piglets from countries like Denmark and Germany, and they do everything to increase their pork production domestically. Well, so far the Chinese have always given their piglets limited amount of whey, but I can imagine with the very high pork prices in China that the demand for whey from the feed sector will increase. And that in combination with reduced production due to reduced availability of drying towers in the EU will probably result into higher whey prices going forward. Martijn, we can buy diesel in 2022. Is this not too long into the future? Well, I think it all depends on the price you can buy your diesel for. If I look at the current prices of diesel, around $400 per ton, I would rather buy than sell, that's for sure, even for 2022. Ray Parker, how does your price outlook reconcile with your view that farm values will go up? I think we have to distinguish between inflation, and I think the farm values will go up due to asset price inflation. At the same time, the global world population is growing, and I think the numbers decline of people dying from COVID-19 is, in the bigger scheme, quite limited, given the global growth in world population of 1.1% per year. So what we are dealing with is a temporarily oversupply, and in the long run, I think the trends of people in developing countries going through an industrialization. So effectively, people are not living on small-scale farms with their own chicken and maybe one pig to feed a family of 15 for the whole year. But people are working in factories or offices for a higher salary due to the industrialization will enable them to buy much more animal protein. And I think in the long run, that trend will maintain.
Mels?
Yeah.
I think it's for time for one final question, and then we go into the panel discussion.
Okay, which question do you want to raise, Yvonne?
From Helene, can you see a behavioral change at the consumers due to COVID-19, more local organic premium?
To be honest, we are a global trading house, and effectively our business model is spotting where there is oversupply and moving that products to regions where there is undersupply. What we do see at this moment of time is that there's actually quite a decent demand, especially in Southeast Asia, in China, a lot of import demands. I also read quite a lot of positive articles about the health benefits of eating yogurts and Yakult-like products stimulating your immune system. There is academic research written about the positive impact of proteins on recovering from viruses. I think overall people are increasing their protein intake in the current market. And that's what I sense, eating more yogurts for breakfasts and these sort of things.
Thank you.
Shall we now go to the panel discussion, Yvonne?
Yeah, that's a good idea. I had a look at the people attending, and I would like to invite Murray from New Zealand. Let me and I'd like to invite Richard Walker from the UK. So let me just, and Ralph Lindmeier from Uruguay. So Murray. There you go. So making sure I'm asking you now to turn on your camera. Hi, Richard. And
hello.
Hi there.
Hi there.
And Murray, yeah.
Hello there.
Perfect.
Hello.
So maybe it's good you three shortly introduce yourselves, your name, where you're from, your occupation. Richard, maybe you start.
Hi there. I'm Richard Walker, a dairy farmer from Scotland in the UK. I attended the Global Dairy Farmers Congress in China this year and really enjoyed it. Learned a lot, and I'm currently undertaking a Nuffield scholarship looking at ways to better integrate British dairy products with global markets, which has had another very interesting dimension added to it in the last 2 months with the COVID crisis. So it'll be really interesting to see how that plays out.
Thank you. Thank you. Murray?
Yeah, good morning, everyone. Yeah, dairy farming in New Zealand with my sons. We kind of specialise in running farms for, I say, aging and absentee owners. And then as well as that, with my younger son, Roger, who I know is on the call, we have farms, 2 farms in Brazil.
Ralph? Thank you, Murray. Ralph?
Okay. Me, right? Yeah. Well, I'm Ralph Lindmeier. I'm an agriculture engineer specialized in dairy farming. I am from Uruguay. Well, I was into dairy trading in a Uruguayan firm for 3 years. In parallel, held my family with a dairy farm. Right now, I'm living in Amsterdam. I'm working here in a trading company, and I'm also with dairy consultancy company, Dairy Next, linked to dairy production.
Thank you. Thank you, Ralph. Richard, I saw you had a question for Mels in the chat. Maybe you could repeat that.
Yeah, Mels, you talk quite a bit about government intervention, both through private storage aid intervention in the EU and directly subsidising farmers during tough times in America. You said that neither would have a long-term positive outcome on dairy markets. All that was doing was kicking the can down the road and kicking the oversupply problem down the road, which I quite agree with. Is there any positive government intervention that you could foresee would help with the oversupply crisis?
I think there are 2 ways to deal with oversupply. It's either reduce your supply or stimulate your demand. What we probably will end up with is a combination of export subsidies and trying to dump your oversupply into areas like Bangladesh and Africa. What I think would be a far better way is, and I believe Murray explained it already during the China trip, that a couple of years ago the New Zealand government had some sort of tender system where farmers could tender their farms for sale, and the government was simply buying farms out of the market. I think that is a far more effective way of reducing supply than subsidizing farmers to stay in business or buying products on the spot and storing them to bring them back into the market several months ahead.
What? Can you still hear me?
Yes, I can.
Yeah.
Yep.
What about a sort of volume reduction incentive that happened in the EU in 2015-16? Does that work? I mean, it's still keeping farmers in business, but it's sort of it's a shorter term solution to the longer term problem.
I think the main problem what we're dealing with, and that's no matter whether we are in the US or in New Zealand or in Europe, we are having the problem that a lot of workers in slaughterhouses are infected with COVID-19. Somehow people working there are poor immigrants with not having the right medical insurances, living with 8 men in the same sleeping room and having to keep on working even if they have a cold. What we see at the moment is that the slaughterhouse capacity is probably running at 50% of the normal capacity. And then the question is, what are you gonna slaughter? Is that beef, bull or cow from a feedlot, which only costs a lot of feed? Or are you gonna slaughter a dairy cow producing 15 liters of milk, which is consuming only grass, and that is for free? I think as such, most likely, yeah, dairy cows will not get sent to the butcher.
Can I?
So what the,
Oh, sorry. I was just wondering, but first you ask your question, Murray, but I'm also wondering about each of your own outlook. So, but first you fire away, Murray.
yeah, well, it was, you had a slide earlier on, Mels, about food insecurity and people's confidence in that. And I mean, this slaughterhouses operating at 50% basically means that animal protein will become very short at the supermarket shelf in a period of time unless people change their eating habits quite significantly. And that will need to be replaced in some form or other. Got any comments?
Absolutely true. You are right. What we see is that the expensive cuts that are normally going to the restaurant sector are the ones which are in oversupply. But let's say the ground beef, which people are cooking their pasta bolognese with at home, yeah, is in very good demand, yeah, and getting scarce. To what extent that meat demand will be replaced by dairy demands, I simply do not know.
Yep.
Mels, one question. What do you think, speaking about the region of South America, that maybe some countries, they don't have so much reserves on their federal banks. What do you think might happen to the farmers as they don't count so much on the government when they're exporting more than 85–90% of the products as milk powders?
Let me first say what I do see is on the import side in South America, we have seen the imports of walnut powder into Brazil declining by 50%. Lately, we at Hoogwegt are exporting a lot of skimmed milk into Mexico. That export is really low at this moment of time. And I think fortunately it's the low season in South America. The South American cooperatives and sellers we speak to have all sold a lot of volume into Algeria with the latest tender and are fully sold out. I think the overall stocks in the dairy exporters in like Uruguay and Argentina in South America are pretty low given their winter and the fact that they have sold a lot already to Algeria.
Okay.
Thank you. I think it's time already. I think we have to, because it's.
May I ask one question?
Sure. Here, final question. Yeah, perfect.
I'm very curious from the three farmers. Given the current COVID-19 outbreak, are you planning yourself to reduce your milk production?
In my farm, no. Absolutely not.
Okay. And what about you, Murray?
So our two components in our business at the moment, what we are trying to do, the level of uncertainty as we look forward, we don't have a projection for the coming year yet from in New Zealand for milk price. So we're trying to figure out how we manage at varying different levels of what money might turn up, given the potential overhang in the market. And so we're just trying to work our way through that and effectively figuring which lever we'll need to pull as over the next few months, what evolves. So being prepared for that. But at the moment, we're coming out of the back of quite a severe drought here in New Zealand, and our focus has been significantly on keeping that locked down for this year, and so that the business is ready to run for the next couple of years. In Brazil, talking to Roger yesterday or the day before, it's business as usual there, but the terms of trade, the relative costs in Brazil of inputs have skyrocketed with the devaluing real. And so what does that mean? How do we manage that as we go forward over this next period? So those are kind of the things that we're wrestling with at the moment through this period of uncertainty as we try to figure out how we might attack this. Thanks.
Can you hear me? Yeah.
Yep.
Yep. In the UK, our processor that we're aligned to sort of told us to reduce volume by 3% on the 19th of April, after initially at the beginning of April telling us they required more milk. The consumption demand is particularly difficult to forecast just now, so it's just day to day and week to week. Spring flush is happening in the UK as we speak. It's our highest output peak part of the year. So through this period, they've asked us to reduce production by 3%. But if that's the worst effect to us through this whole crisis, then that we've got off pretty lightly. The market in the UK is completely fragmented, and it's all down to the relationship and the contract you have with a milk processor. There are some farms in the UK have been having to dump milk that are wholly exposed to food service markets, coffee shops, takeaway restaurants, bakeries, food service type stuff, hotels and restaurants. The farmers that are aligned to those types of businesses are really struggling. They've had deferred payments, they've had to dump milk and reduce volume. Others on retailer aligned contracts, for example, retailer aligned liquid contracts are still being paid, which we happen to be actually, are still being paid a top price. Liquid sales in multiple retailers are strong across all categories in dairy. So yeah, it really comes down to which processor you're aligned to and what their market exposure is, as to which side you're going to end up on. It's just the nature of the way the UK dairy processing market has been built up.
Thank you. Thank you, all of you, for participating in this panel discussion. Now, let me. So, whoop, whoop, whoop. Sorry about that. Whoopsie whoops. Yeah. So, Ott, are you there? Oh, yeah. You are there now.
Yeah.
Yeah.
Thank you, Mels, for your presentation. Your view on the market is always very pragmatic, based always on data and numbers, and therefore very interesting. And thanks again. Thanks also to the panel members. Thank you all guys from all over the world. It's great to have you here. I saw there were still some open answers, and we will try these answer all the questions the coming days. Go to the upcoming webinar. Attention for our next webinar, May 27. Subject is a very innovative and sustainable way of feeding cows. John de Jonge, he's from Artex. He is business partners, very loyal business partners of Global Dairy Farmer from the early beginning. He already gave us a glimpse of this new initiative at our Congress in China, but during this webinar, he will go deeper into it. It seems to be very interesting, and please make a note of the date, May 27. Now we go to the last slide, and I would like to thank everybody for attending this webinar. It's our first webinar. I think it's successful. And if you want to know more about GDF, please contact us. We are open for new dairy farmers and business partners. And finally, take care and stay healthy. Bye-bye. See you next time.